Millions of Americans own a personal computer. If you're one of them, you can now glimpse the future with nothing more than a modem, a phone line, and a few dollars a month.
Oh, that's
that little
right.
mark with the A and then the ring around it.
At.
See, that's what I said. Katie said she thought it was about.
Yeah. Oh.
But I'd never heard it.
Around.
I'd never heard it
about.
said. I'd always
That's
seen the
right.
mark, but never heard it said. And then it sounded stupid when I said it. Violence at NBC.
Just what is this main artery of the information superhighway?
Every business, no matter how large, and no matter how small, will be on the internet in the year 2000. It's the primary way that people will look up information. It will replace the yellow pages as we know it today.
Are a lot of people just getting on to the internet because they feel that they have to get onto the playing field, so to speak?
Well, it's very hip to be on the internet right now.
There it is. Violence at NBC, GE.com. I mean...
Well, Allison should know.
What
do you
is
say about
internet
Allison?
anyway?
Internet is that
Massive computer network.
the one that's becoming really big now.
What do you mean? That's big. How does one? What do you write to it like mail?
No, a lot of people use it and communicate. I guess they can communicate with NBC writers and producers. Allison, can you explain what internet is?
No, she can't say anything in 10 seconds or less.
I'm afraid that if I subscribed to something like internet,
You would really be hooked.
I would get hooked and I would never, spend time with my family.
Dot-com bubble of the late 1990s and early 2000s is a striking example of how markets can overinflate the value of a promising technology. At its core, the bubble was fueled by the transformative potential of the internet, which was seen as a revolutionary force capable of reshaping economies, industries, and societies. However, unchecked speculation, excessive optimism, and a lack of sustainable business models led to one of the most significant financial downturns in recent history. We explore the rise and fall of the dot-com bubble, examining its origins, its impact, and the enduring lessons it offers for navigating similar phenomena in the future. Bubbles often form around innovations with transformative potential, and the internet was no exception. The internet's capacity to revolutionize communication, commerce, and information access captivated investors and entrepreneurs alike. By the mid-1990s, it became clear that the digital economy was not a fleeting trend, but a structural shift that would redefine global business. Early pioneers such as Netscape, Amazon, and eBay demonstrated the commercial possibilities of the internet, igniting a wave of enthusiasm that culminated in a speculative frenzy. The origins of the dot-com bubble can be traced to the commercialization of the World Wide Web in the early 1990s. Companies like Netscape became symbols of the internet's potential, as its initial public offering, IPO in 1995, saw its stock price surge by 250% in a single day. This landmark event signaled to investors that the internet was not only a technological marvel, but also a lucrative investment opportunity. As internet adoption grew, by 1999, nearly 40% of US households had internet access. The race to capitalize on the new economy accelerated. The late 1990s marked the height of the bubble, with a surge in the number of internet-related IPOs. Startups with .com in their names attracted enormous venture capital funding, often with little more than a business plan to justify their valuations. The Nasdaq Composite Index, which was heavily weighted toward technology stocks, more than doubled between 1998 and 2000, peaking at over 5,000 points in March 2000. This meteoric rise was driven by a mix of investor exuberance, media hype, and corporate FOMO, fear of missing out, as established companies rushed to invest in digital initiatives to remain competitive. However, many of these startups lacked the fundamentals to sustain their high valuations. They prioritized growth over profitability, operating on the assumption that market dominance would eventually translate into earnings. Companies like Pets.com and Webvan epitomize this trend, with ambitious marketing campaigns and rapid expansion plans that ultimately proved unsustainable. Pets.com, for instance, invested heavily in advertising but failed to generate sufficient demand to offset its high operating costs, leading to its bankruptcy. The bubble began to burst in March 2000 as investors started to scrutinize the lofty valuations of internet companies. Concerns about profitability and sustainability led to a sharp decline in the Nasdaq, which lost nearly 80% of its value by the end of 2002. Interest rate hikes by the Federal Reserve further exacerbated the downturn, reducing the availability of cheap capital that had fueled the bubble. The collapse wiped out trillions of dollars in market value, leading to widespread job losses, bankruptcies, and financial ruin for many retail investors. The economic impact of the bubble's burst was profound. An estimated $5 trillion in market value was erased, and the US economy entered a mild recession in 2001. The tech sector, which had been the engine of growth during the late 1990s, became a source of economic vulnerability. Hundreds of thousands of workers in the technology industry lost their jobs, and many startups went bankrupt, leaving behind a trail of shattered dreams and disillusioned investors. Beyond the economic consequences, the bubble's burst also had significant social implications. Retail investors, many of whom had been drawn to the stock market by the promise of quick riches, saw their savings evaporate. This erosion of wealth undermined public trust in financial markets, prompting calls for increased regulation to prevent future speculative excesses. The dot-com bubble also highlighted the dangers of herd behavior and the importance of due diligence in investing. One of the enduring lessons of the dot-com bubble is the distinction between a company's market price and its intrinsic value. While some companies, such as Amazon and eBay, survived and thrived, many others lacked the fundamentals to justify their valuations. The bubble underscored the importance of sustainable business models and the risks of investing based solely on hype and speculation. The dot-com bubble also serves as a reminder of the recurring nature of financial bubbles. Similar phenomena have been observed throughout history, from the tulip mania of the 17th century to the housing bubble of the early 2000s and the cryptocurrency bubble of 2017. These episodes demonstrate the universal patterns of speculative excess and subsequent correction, driven by a mix of optimism, greed, and irrationality. The causes of the dot-com bubble are multifaceted. Speculative investment played a central role, as venture capitalists and retail investors poured money into internet startups without proper analysis of their business models. Media hype further amplified the frenzy, with financial publications and analysts often overstating the potential of internet companies. The rapid proliferation of IPOs also exposed regulatory gaps, as many startups went public without meeting the stringent requirements traditionally associated with public offerings. A significant factor contributing to the bubble was the failure of many dot-com companies to establish viable business models. Examples abound, from Pets.com to Webvan, whose ambitious plans were ultimately undone by their inability to generate sufficient revenue. These failures highlight the dangers of prioritizing growth over profitability and the importance of aligning business strategies with market realities. Despite the devastation caused by the bubble's burst, it also laid the groundwork for the internet's eventual success. Companies that survived the downturn, such as Amazon and Google, emerged stronger and more resilient, having weathered the storm of market correction. The bubble also accelerated investment in internet infrastructure, paving the way for the digital economy that underpins modern society. The lessons of the dot-com bubble remain relevant as we navigate new frontiers in technology and finance. Emerging sectors such as artificial intelligence, renewable energy, and blockchain technologies are generating similar levels of excitement and investment. While these innovations hold immense potential, it is essential to approach them with a balanced perspective, emphasizing sustainable growth and rigorous valuation. The dot-com bubble serves as both a cautionary tale and a source of valuable insights. It underscores the importance of distinguishing between hype and reality, understanding the fundamentals of business, and maintaining a long-term perspective in investing. The emerging AI bubble. The rapid development and adoption of artificial intelligence, AI, technologies in recent years have captivated investors, entrepreneurs, and governments alike. AI has been heralded as the new electricity, a transformative technology poised to revolutionize industries, redefine economies, and address critical societal challenges. This enthusiasm has spurred a wave of investment, leading to soaring valuations of AI-focused companies, reminiscent of the dot-com bubble of the late 1990s. However, this exuberance also raises questions about whether the current AI boom might follow a similar trajectory to the dot-com mania, culminating in an unsustainable bubble. We explore how the excitement surrounding AI mirrors the dynamics of the dot-com bubble, the risks of overvaluation and speculative investment, and the potential long-term impacts on the technology sector and global markets. AI has seen remarkable progress in recent years, fueled by breakthroughs in machine learning, natural language processing, and computer vision. Technologies like ChatGPT, autonomous vehicles, and facial recognition systems have demonstrated the practical applications of AI, sparking widespread excitement about its potential. Companies that integrate AI into their products and services, ranging from tech giants like Google and Microsoft to startups developing niche solutions, have become the focus of significant investment. Venture capital funding for AI startups has skyrocketed. According to Stanford University's AI Index Report 2023, global private investment in AI grew from $18 billion in 2016 to over $93 billion in 2022. Meanwhile, public markets have seen a surge in the stock prices of companies associated with AI, such as NVIDIA, a leading manufacturer of GPUs critical for AI training, whose market capitalization surpassed $3 trillion in mid-2024. This rapid growth has drawn comparisons to the dot-com era, where companies with any affiliation to the internet experienced similar valuation surges. Overvaluation and speculative behavior. The parallels between the AI boom and the dot-com bubble are striking. During the dot-com era, many companies attracted massive investments based on vague promises of revolutionizing traditional industries without demonstrating sustainable revenue models. Similarly, the current AI landscape is rife with speculative investments. Companies touting AI capabilities often see their valuations soar, regardless of whether their AI applications are practical, profitable, or even fully developed. A study published in Management Science highlights that firms adding AI or machine learning to their names or marketing materials often experience a temporary boost in stock prices. This phenomenon reflects a speculative mindset where investors chase trends without fully understanding the underlying business models. For example, smaller firms with limited expertise in AI may rebrand to attract investment, similar to the proliferation of dot-com startups in the 1990s. The dot-com bubble serves as a cautionary tale for the current AI mania. Like the internet, AI is a genuinely transformative technology with enormous potential. However, overblown expectations and misaligned incentives can lead to bubbles, as seen in the late 1990s. During that period, the promise of the internet drove speculative investments in startups that often lacked profitability or even a clear path to generating revenue. The resulting market crash wiped out trillions of dollars in value and forced many companies into bankruptcy. AI's potential to replicate this pattern stems from similar factors: rapid technological advancements, speculative investments, and a rush to capitalize on a perceived gold mine. For instance, AI's promise to revolutionize industries such as healthcare, finance, and manufacturing mirrors the internet's promise to transform communication, commerce, and information sharing. However, just as the dot-com bubble revealed the limitations of internet-based business models, the AI boom may expose the practical and ethical challenges of integrating AI into complex industries. Risks of the AI hype. One of the primary risks of the AI boom is the overvaluation of companies that lack sustainable business models. While companies like OpenAI and DeepMind have demonstrated AI's potential, many others are built on speculative promises. Startups focused on AI-powered solutions often face challenges such as limited scalability, high development costs, and difficulty in achieving market adoption. These challenges may not align with the lofty valuations attributed to them by investors. Moreover, the ethical and regulatory challenges of AI could constrain its growth. Governments worldwide are grappling with issues such as data privacy, algorithmic bias, and the potential misuse of AI technologies. These regulatory hurdles could slow the adoption of AI and reduce investor enthusiasm. For example, proposed legislation, like the European Union's AI Act, aims to impose strict rules on high-risk AI applications, which may increase compliance costs and limit profitability for companies in the sector. Signals of an AI bubble. Several signals suggest that an AI bubble may already be forming. First, the unprecedented surge in AI-related IPOs and venture funding echoes the proliferation of dot-com startups in the 1990s. Second, media hype and public fascination with AI often outpace the technology's actual capabilities, leading to inflated expectations. For example, while generative AI models like ChatGPT have garnered significant attention, they are not without limitations, including issues with accuracy, ethical considerations, and computational cost. Third, AI's integration into public markets has seen exaggerated reactions. NVIDIA's $3 trillion valuation is a case in point. While the company is undoubtedly a leader in AI hardware, its valuation assumes sustained exponential growth that may not materialize. Similarly, the rise of AI ETFs reflects investor attempts to capitalize on the trend without a nuanced understanding of individual companies' fundamentals. Consequences of a potential AI bubble burst. If an AI bubble bursts, the consequences could be severe, echoing the fallout of the dot-com crash. Companies with unsustainable valuations would face sharp declines in stock prices, leading to significant losses for investors. Startups reliant on venture capital may struggle to secure additional funding, resulting in layoffs, bankruptcies, and reduced innovation. The broader tech sector could also face reputational damage, as skepticism about AI's potential might deter future investment. This skepticism could slow the pace of AI development, delaying the realization of its full potential. Furthermore, the economic impact of a burst bubble could extend beyond the tech sector, affecting global markets and consumer confidence. To mitigate the risks of an AI bubble, stakeholders must emphasize sustainable growth and realistic valuations. Companies should focus on developing practical applications of AI that address genuine market needs rather than chasing speculative hype. Investors, in turn, should prioritize rigorous due diligence, assessing not only a company's AI capabilities, but also its broader business model and financial health. Governments and regulatory bodies also have a role to play in ensuring responsible AI development. By establishing clear guidelines for ethical AI use and addressing potential risks, policymakers can create an environment that fosters innovation while minimizing speculative excess. For instance, encouraging transparency in AI algorithms and data practices can help build trust among consumers and investors. The dot-com bubble demonstrated that technological revolutions take time to mature. While the internet ultimately transformed the global economy, its initial overvaluation led to significant disruptions. Similarly, AI is likely to reshape industries and societies over the coming decades, but its path will not be without challenges. The parallels between the dot-com bubble and the current AI boom underscore the importance of balancing optimism with caution. By learning from the mistakes of the past, investors, entrepreneurs, and policymakers can navigate the complexities of the AI revolution more effectively. This measured approach will help ensure that AI fulfills its promise as a transformative force without succumbing to the pitfalls of speculative excess. Managing the AI revolution. The AI boom holds immense promise, but it also carries significant risks. Like the dot-com bubble, the current enthusiasm for AI is driven by a mix of genuine potential and speculative behavior. To harness AI's transformative power while avoiding the mistakes of the past, stakeholders must prioritize sustainable growth, realistic valuations, and responsible innovation. As AI continues to evolve, its success will depend on the ability of investors, entrepreneurs, and policymakers to manage expectations and address challenges. By fostering an environment that supports long-term innovation and accountability, the AI revolution can achieve its full potential, delivering benefits that extend far beyond the hype. Only by approaching AI with a balanced perspective can we ensure that its impact is both profound and enduring.
Thank you so much for watching. If you found this video valuable, please give it a thumbs up and hit the subscribe button. It's one of the best ways to help more people see this content. I'd love to hear your thoughts. So leave a comment below and join the conversation about today's topic. Your engagement and support mean everything to me and make it possible for me to create more impactful content that aims to bring the world closer together. If you'd like to take it a step further, you can support the channel directly through the link in the description. Every bit of support helps this community grow and fuels the mission to make a difference. Thank you for being such an important part of this journey.